Welcome back to another episode of What's on Your Mind. Today on the show, I've got Raj Malhotra and Jason McDonald joining me. Gents, it continues to be a pretty rewarding market environment for long-short strategies, given that there's been some decent volatility and plenty of rotation amongst both kind of sectors and factors as well, as David pointed out in the last episode of What's on Your Mind. So I'm interested to hear what both of you guys have to say, what you've been thinking about over the last few weeks, given that backdrop. And with that being said, Raj, why don't we chuck it to you first and discuss what's been on your mind?
Thank you, Chris. How's it going, Jason? It's good to see you both again, or over from the UK. Back to your question. You know, what's been going on in the U.S. in my mind is that there's been a really a move away from growth names right here. As you can tell, every time the market sells off, growth names sell off much more than the market. And on rallies, they don't. The growth names don't make new highs. So it's really been a move back into more value names. It reminds me a lot more of early Q4 of 2019, where value names were really in favor. And so here's a trading tip. If you really like growth names, I suggest you use market weakness to accumulate positions. And as markets sell off, if you want to be a short growth names, use that market strength to get short these names, because they still are in a bit of a range, and they're not trading on fundamentals on each growth name per se. They're just trading. They're moving at those levels just due to the relative market. So it's ironically, the correlation between those names has been much, much higher than value names. And value names is really where you get more of the fundamental view, and how I've been looking at my long, short relative value names here.
What about on your side, Jason? Have you been looking at sort of any macro?
Yeah, hi guys. I mean, as usual, I'm looking at things first of all from the top-down macro perspective, and then looking to build up from the bottom, reflecting the macro situation. I think we're all pretty well versed in what's been going on with respect to the leading indicators and the large global blocks. So obviously the US, Europe, China. But and on that front, I guess we've got more bad news this week yet again. In the Eurozone, France and Germany, we had European, Germany and France manufacturing PMIs out, and services PMIs as well earlier this week, all missing forecasts. Germany, which clearly is the most important country in the EU, again falling to, this is for the German manufacturing PMI, again falling to actually its lowest reading since early 2009, which is obviously not great. And I think Eurozone demand for goods and services fallen to like a 6-year low. So, it very much looks, as a lot of people have been saying, let's face it, this is not a revolutionary opinion, it's very much consensual, that Germany and some other countries within the Euro could actually be falling into recession next year. And then, on the other hand, you contrast that with, okay, we've got some indicators coming back with respect to the US, but it still looks, on a relative trade, it still looks like the place to be, doesn't it? I think we can really clearly see why the ECB cut their discount rate again to further negative, and why they're now going to be going back into QE, which of course is showing diminishing returns. Again, nothing new there in terms of representing that. But it's still, we can't get away from it. I think also, I don't want to spend too much time on this, but I suppose I can't really, being based in London, not mention what's happened yesterday with respect to Brexit. So in terms of the actual facts of Brexit, there's nothing new on that front, in that we are still allegedly leaving at the end of October with either a deal or no deal. However, we had a big call from the Supreme Court in the UK, which all 11 judges unanimously voted that that Boris Johnson, the Prime Minister, had actually acted illegally in prorogating or in suspending Parliament, and is essentially the the viewpoint was about as bearish as it could be if you're the Prime Minister and his advisors. So it doesn't really change much on the Brexit front per se, but it means that today Parliament's actually back open again. And again, it's just another sort of low point in the increasing number of low points that the UK has been racking up in the last 2.5, 3 years. So that's, where we are with respect to the UK. I think going back to the macro stuff, we've talked about on What's on Your Mind quite a long time ago, this thing TINA. So there is no alternative. And I think that, on that front, we need to think about where the US is on a fundamental perspective relative to other parts of the world, but also this idea that, with so much negatively yielding debt around the world at the sovereign or government level, that, well, okay, yes, we are close to all-time highs on the equities front in the US, but, the counter argument is, but where else are you going to put your money? So, if we look at, I think it's something like we're up to $14.8 trillion worth of negative yielding debt globally. I'm going to say that again, $14.8 trillion. And so I thought this was very, very funny, actually. The head of the Monetary and Economic Department at the Bank of International Settlements, so this is like the Bankers Banking Association, he said the other day that we have a growing number of investors who are paying for the privilege of parting with their money. Even at the height of the global financial crisis, this would have been unthinkable. There is something vaguely troubling when the unthinkable becomes routine. Now, this is from the head of the Monetary and Economic Department at the Bank of International Settlements. I mean, this is how, weird kind of the world has become. So, I had a look at the banks and just to throw some numbers out there, we're talking about Japan, that's obviously had, 10 years of unusual monetary policy. I think the Topic 600 bank index trades at less than half times book value. Their banks are returning 5% return on equity, which is pathetic. The European bank situation, we've talked about this a lot on What's on Your Mind, with respect to Deutsche Bank and some of the other European basket case banks. European banks index, the stocks banks index trades at 0.55 of book value, 7% return on equity. And you compare that with the US, where you've got banks trading greater than 1 times book value, so more than double. And, they've got a 12% return on equity, which at least is respectable. So it is a bit boring, it is a bit dull, but it's still quite hard to get away from. So that's those are some of the things that have caught my attention. Another thing that caught my attention overnight was which I wanted to ask Raj about was where are we sitting here with impeachment? I thought that had all gone away. Actually, I thought that was early in his presidency, and it's now all kind of disappeared. But something seems to have happened overnight. So, what are you thinking about that, Raj?
All right. Well, first of all, I've reached the lower lows in the UK. And by the way, if you want to lend me 14.8 trillion, I promise I'll give you back 14.5 trillion a year. So what a great business model. Economy scale. If you borrow $15 trillion and pay back less, I can certainly live off that for the rest of the year, and I probably will stop investing. But anyway, back to your question about impeachment. It's kind of, to me, actually, this is actually, if you look back at the Trump presidency, every time there's been a negative headline, tweet, whether it goes back to China, impeachment, scandal, porn star, any of these things, it's been a buying opportunity. And this probably is another buying opportunity because, he's amazing. Whether you like him or not, he's simply the Teflon Don. Everything that they try and throw at him doesn't stick. Now, specifically to your question about impeachment, like this one is, they've tried, whether it's Russia, they've tried. This impeachment one is because he talked to the president of Ukraine and basically said that to look into Joe Biden's son, he's not debate. He's been arrested for crack. He's been he basically peddled influence with the Chinese and the Ukrainians to get essentially government business. So now that they're saying that's an impeachable offense, I don't buy it. But even if you did buy it, even if you believe that this was impeachable, even if he does get impeached in the House, it's all a political stunt because they need a simple majority in the House to get impeachment, and the Democrats have more than a majority. But in the Senate, they would need 2/3 of a vote to impeach, and the Republicans have something, I think, 53 seats. So they would need 20 Republicans to jump on board and say, let's impeach Trump. Again, it's all a political stunt during an election. Every candidate for running for president is saying we need to impeach, but only to basically strengthen their case that Trump needs to be defeated in next year's election. So it's just more noise. And the ironic thing about the whole thing is what they're talking about, the impeachable offenses. There was a whistleblower that they said has evidence that Trump did something wrong, but they're calling for impeachment, but they still haven't seen the evidence. So I don't know how you can. That's like me saying that that I have evidence that Jason is guilty of murder, but I haven't seen the evidence yet. So it's another one of these political stunts, and I really don't think it goes anywhere. And ironically, it actually probably strengthens it more because the people that are just kind of on the fence just see that this is just a political ploy. So, yeah, that's my 2-minute Trump Teflon Don diatribe.
Let's focus down on some sort of stock ideas or sector ideas at least then, and perhaps we'll keep going with you, Raj. You had a couple of longs you were thinking about.
Yeah, actually, I remember, if you guys remember a couple episodes ago, I talked about BFAM, which is Bright Family Solutions, basically a child care company. And essentially the thought, even economic slowdown, and I'm not calling for recession, but even in a slowing economic environment, the two places people do not stop spending on. People continue to spend on their kids because they love their kids. They hate adults. They hate their spouses. They hate their friends. But they love their kids and they love their pets. So a sector that I really liked was animal health. So one name I've been looking at recently, I'm just look at my notes again here, is Elanco. This one's a little bit of a tricky situation. In this sector, a name that I've had in my portfolio for all year since the beginning of the year is ZTS Zoetis, which is the market leader in animal health. They're up about 30% or so this year, maybe even more. I have to look at it again. I make so much money in my trading, I can't remember how much names are up sometimes. But anyway, Zoetis was spun off from Pfizer a few years ago. It trades about 30 times the earnings. And it's, I like this whole sector. So Elanco, they basically bought the animal health business from Bayer, the European company, which, Bayer is, if you guys don't remember, Bayer actually bought Monsanto, was it a couple years ago? Monsanto, which I thought at the time was a strange acquisition because Monsanto is more of a agriculture crops type business. And anyway, they bought it because Monsanto's got all these herbicide lawsuits. So basically, Bayer had to sell this animal health business, which is really like one of the better business they had for cash. Not that they wanted to sell it for cash. They needed to sell it for cash because they needed the cash for these lawsuits that are coming up. So they basically kind of distressed sold it. Now the market initially punished Elon when they bought this, when they bought the animal health business, because it's a $10 billion market cap and they paid $7.6 billion, and the market thought that was too much debt for them. And the market sold off from like a peak of like 36 down to around 27. Elon spun off from Lilly a year ago, and it's now the combined company is going to be the second biggest animal health company in the world. And there's only about 5 of these players worldwide. And I really believe it's a similar story to that. If your dog is sick, you're not gonna, more and more animals are treated as a member of the family, and a lot of millennials are just, not having kids and prefer to have dogs or cats. I mean, Chris, how many dogs do you have?
2.
Okay, see, there we go. There's my point. So would you stop, if your dog was sick, would you not take him to the vet?
Of course.
So there we go. So again, it's recession-proof. I think that I think the market's punished them too much because you can look, even though it's over-leveraged, I think within a year or two, the leverage comes down because the revenues are just so strong and they're very, very predictable. And it trades at around 17 times earnings, while Zoetis trades 30 times earnings. Granted, they have a lot more debt and it should trade there. But as you know, the name, as all this filters through, it should get stronger. And I really think you're kind of getting at a discount from where it was right before this merger. And again, it's with only 5 players in the industry. This industry is growing like something like 15% year over year. So I don't really see a lot of downside for this trade here. And it's a bit of a turnaround story. Now, again, I don't know if the options strategy is the right one, but if you wanted to, because to really trade an options position in my mind, this is probably a year out. It's kind of not the kind of name that's going to have an immediate rally, but in terms of value names, value versus value, I don't think it has a ton of downside. But if you did want to look at option structure, the one that I looked at was the April 30-37 call spread. It looks like you can pay about $2 for the 30s and sell the 37s for about 40 cents. So essentially, you make $1.60. If you pay $1.60, you can make about $5.40 if the stock goes back to around the level it was before this merger. So you get more than a 3-to-1 payoff, and really it's fundamentally a name that I just think in our portfolio it's probably something to own, just because of the way the sector is positioned going forward, no matter what happens in the economy, in the U.S. or around the world.
Yeah. Let's switch over to you, Jason. What about on your side? Are you looking at longs or shorts today?
Yeah, I've actually got a couple of long ideas to talk about. One a bit more developed than the other. And this is very different. I suppose you could call it value actually, but it's quite different from Raj's idea here. It's a little bit of a, it's kind of counterintuitive for people that have done our education, let's say. So it kind of breaks some of those in inverted commas rules, but we're not rules based, but we're kind of principle based. So basically I've been looking at a company called The Gap, ticker GPS. The market cap's about 6.5 billion. It actually yields 5.5%, which we were talking about interest rates earlier on. It's pretty good in this environment. Short interest in this company is 15% of the free float. So it's a fairly consensual short. Share price is currently around $17. It has been a bit lower than here, but if you look at 1 year, 2 year, 5 year chart, this thing has been getting sold off consistently, and we understand that the reasons why are well understood. So what I was thinking was actually this is more of a short-term trading play rather than Raj is talking about the pet healthcare stock is probably a bit more longer term, but this is more of a short-term trading opportunity potentially. I'm thinking, we're basically a few weeks away from Black Friday, which of course is the traditional start of the shopping season in the US. We have a consensual short here, and we know what can happen to consensual shorts on occasion. This company, give you the numbers, sales are actually expected to fall next year 1%. They're expected to grow the next year by 1%. It's a very lowly rated PE stock, so this is where we're kind of going against the grain a bit. PEF1 is 8.3 times, PEF2 8.2 times. Earnings growth this year is horrendous. It's negative 20%. Next year we're looking at anemic, possibly 1.5–2% earnings growth. So we're clearly not going into this for its growth. And that compares to the industry PE average, maybe around 11 times. Earnings growth this year is flat. But this company it's had a bit of sort of fundamentally upticky type news recently. They're basically going to spin off into 2 companies next year. They're going to put so they have one part of the business called Old Navy, which is which is much better from a growth profile, and then they've got the sort of traditional old business, which ironically enough they're calling Newco at the moment because they haven't thought of the name for it. And that's basically focusing on the Gap, Banana Republic, Athleta, those type of brands. So they go in one pocket, which is Nuco, and then they've got Old Navy, which is actually the more interesting part of the story. So, you know, you could call that a fundamental catalyst, but I'm actually not really looking at that. It's more that, you know, given the consensual nature of the short, is there, you know, if we get a bouncy kind of positive shopping season, does this put a bit of a bid on some of these beaten down retail stocks? So what I had a look at was some potential options trade. So I think we're probably pretty much aware of what a risk reversal is, but I'm just going to spell it out for those that don't know. So I'm looking at something like a short put long call, which is quite an aggressive trade to do actually. So I've been looking at the stocks around just over $17, possibly selling the mid-November $16 puts, and looking at buying the January $19 calls. So clearly, you know, both of these strikes are away from the market at the moment. They're out of the money on both sides. That's going to cost you about 40 cents to put on. As I say, that's it's a relatively aggressive strategy. You know, you could look at things like call spreads or calendar call spreads, which is less aggressive, clearly. And I'm kind of looking for cheap ways to basically take a look, really. So that's what I was looking at with respect to the Gap. The other one that I only just started looking at was another consensus short, but not so big. It was much earlier in the year, a lot bigger, but it's kind of it's been reduced markedly, is Under Armour, which might be one to look at as well from that perspective. And then the other one I was looking at, which is a trade that some other institute traders have actually got on as well, is Royal Caribbean. So tickers RCL. Company's about 22 billion market cap. This has got much better fundamentals than the Gap, quite frankly. Basically, we're looking at 15% sales growth F1. This is sales. 8% revenue growth, sales growth F2. We're looking at 10% earnings growth this year, maybe 11% next year. It's still on a bit of a discounted P rating compared to its competition, and that is because this was a China growth story. So guess what? Stocks had a bit of a pullback on the basis that the Chinese are never leaving the country again. The growth story is in tatters. The trade war headlines, etc., falling China GDP growth. We know what the commentary is here. But my view is that this thing has fallen. It's actually bounced a bit, but it's fallen to relatively attractive levels. And are we really saying that the Chinese middle classes are going to stay put in the Middle Kingdom and never come out again? I don't think so. So I think it's worth looking at from an options perspective as well. So I've been looking at possibly doing a January long 120, short 130 call spread. The stock price is currently just below 109. So we're talking about, buying the 10%, selling the 20% out of the money strike for January. There's interestingly, and I'd like to ask Raj about this actually, what he might think about this, but there's a very large open interest in the October 115 calls. And I think that might be because there's a hedge fund out there that's quite short, and they've had to do that as some kind of hedging policy. But wondering if you had any insight into that, Raj, or any input.
Yeah, Jason. So I'm not sure specifically about that trade. I didn't see that, but it does sound like a hedge to a short for a big hedge fund. And one thing to note, in terms of options structurally, especially a name like RCL, which doesn't have it's not a very active option market. So if the market makers are long that 115 strike, it tends to be unlikely that it'll finish anywhere near that, because market makers just push the stock away from that. So my point is, it's more like it's unlikely to be anywhere near 115. It's probably going to be 115, or if it's going to go all the way through, it's probably going to go much higher towards like the 120, 125 strike because of all that demand for market makers having to hedge their positions and essentially buy back all their short stock against those long calls that they have. So I think that that's a way, something we talk about at the Institute to teach students how to use options fundamentally. But I really do think that if you get to around that strike and there's some positive news, you should definitely be buying it right around that level because there was just you, in addition to market makers, have that demand to buy that stock at that level. And, fundamentally, I kind of agree with you, RCL. Another thing is around the holidays, everybody wants to send their parents away on cruises and not talk to them for a week. So that's a perfect time to buy RCL. With demographics in the U.S., old people, you want to send your parents away on cruises and not bother you. I know I would like to do that sometimes, but my parents hate cruises. So just like me, my mom gets seasick, and that gets me vertigo as well. So anyway, so you wanted to talk about, speaking of, bad news and getting drunk. So one of my short ideas here is actually TAP, which is Molson Coors. If you look at the, it's about a $12 billion market cap. They're projected basically have zero growth for the next 3 years in beer. That company themselves are saying we're going to have no growth. And I think you all know when something doesn't grow, it goes down. I mean, no growth is a negative for a stock. If you can't grow, you lose. I mean, that's why when I started on Wall Street, I was 5'6". Now I'm 6'5". So I've grown tremendously, and that's the kind of, those are the kind of people you want to invest in. But in all seriousness, like in terms of the qualitative story on Molson Coors, I mean, they're in Colorado. They basically have one brewery. Their brands are just kind of boring. No one, millennials don't seem to want to drink Coors or Molson. All millennials, in terms of beer itself, is not really a growth industry. But if you look at it specifically in the beer industry itself, all the growth is in microbreweries. Millennials are drinking microbreweries because they want to be cool. They have the new Magic Hat or Fog Hat or ones with funky names. And the old school companies like Miller, Molson, Coors, Bud, those are out of favor. People almost make fun. Millennials almost make fun of you if I order a Bud Light at a bar. So in terms of that, that's one real headwind to this stock specifically. The other thing that we're talking about, especially in the U.S., which is the biggest beer drinking country in the world, is that there's been a shift away from drinking beer to legalized weed. And Coors themselves is in Colorado. That's most of their regionally. If you look at regionally, the majority of their sales are in the Midwest region, and that's not the Midwest, like the Mountain West region, and that's where weed is becoming legalized. So you look at alcohol consumption in Colorado, Washington, the places where the weed is already legal, it's on the decline. And as other states legalize weed, it'll be hard to imagine that the other states wouldn't follow suit. So having to even say that we're going to grow at zero might be an aggressive call or aggressive. Might be aggressive numbers for Molson Coors to actually reach in the next 2 years. The PE again is low. It's 12, but it's going to continue to be low, and I just don't see a way that they grow in a business where there are all these headwinds. In terms of like strategy, I was looking at this yesterday. If you look at the November 57.5 45 put spread, you can pay $3 for that put spread and make $12.5. Make $9.5 on that. So basically, it's a little more than a 3-to-1 payoff. If the market sells off 20% by November, that might be a big move. But it's just a name without any growth. And if you have any kind of pullback in the market, I expect Molson Coors to have weakness. I mean, even if you look at this year itself, I mean, the S&P's up 20% and the stock's down 10%. So the story's out there, but there's no reason to think that the weakness doesn't continue, in my opinion.
Yeah. Excellent, gents. Well, I think we'll wrap up this episode there. It's always a pleasure to have you guys on the show, and we've covered some good ground today, plenty of market insights. So thank you both for those. But before I close the show, I just want to make sure you guys watching head over to our website, itpm.com, where you can keep up with all of our news and events that we've got upcoming. So a couple of things stick out in terms of webinars. We've got one which is called Is the US Stock Market Going to Collapse? That's hosted by Ross Williams and Anton Creel. Another on the 12th of October, which is an alumni webinar. That's hosted by Jason here and Anton, and that's an open Q&A forum. Aside from webinars, we've also got VIP lunch opportunities coming up. The next one being with David Perlin in Washington, DC. That's on the 11th of October. And then Jason and Raj here also have a couple of opportunities coming up as well. So Raj is doing a lunch in New York and Jason in London. So those are all great events. And if you're interested in those, then do go to the website and sign up. And as well, if you're enjoying the What's on Your Mind content that we have, you're probably interested in learning how to build and manage your own global long-short portfolio. And if that's you, then you can head to the website to learn that as well through any of our video education courses or our mentoring programs with guys like Raj and Jason here. So that's all from us. Thank you guys for watching, and make sure you join us next time for another episode of What's on Your Mind.